A very good morning to all of you today. Our session for today is fundraising. And I know that a lot of you are looking at fundraising in the short or long term. So let's dive right into it. Our speaker for the day is Jonathan Graff, a venture partner at Celtic House Venture Partners, an Ivy MBA grad from 1997. Thanks for joining us, Jonathan.
Great to be here.
Brief introduction about Jonathan. Jonathan has spent almost the last 2 decades as a founder and operator of early stage tech startups, most notably as the president of Caboose, building it from 5 to over 500 employees and taking it public on the Toronto Stock Exchange and eventually selling the company to Disney. He currently spends most of his time with Celtic House, where he has invested in 3 tech companies, one in seed round, one in Series A, and one in Series C. Jonathan's experienced on both sides of the capital raising table, raising and investing over $150 million as a founder and president operator, as well as an angel and a VC investor. With that, we know that we have notable experience in the room to talk to us about fundraising. Let's see what we're going to talk about. Almost all startups need external financing, but new entrepreneurs rarely have the training required to decide what kind of fundraising would be apt for them. They try and raise their funds through family and friends or through more formalized approaches. Today, we will look at what is suitable for you and how to go about it. In this workshop, we will get to grips with the basics of funding a startup and understanding the process of successful financing rounds. The workshop is aimed at entrepreneurs like you who are considering and preparing a financing round, or anyone looking to get a better understanding of the factors, processes, and consequences of a financing round. We'll explore how important financial backing is for the success and how to attract and negotiate with investors. A couple of primary topics that we're looking to dive into is what are the different fundraising options available and what option would suit you best? How can I identify and convince potential investors? How can I estimate the financing need and the value of the venture? How do I negotiate with equity investors? And how can I best prepare and succeed in a post-investment phase?
This could be a 4 or 5 hour talk. If we cover everything there is to cover about financing, even, at the beginning of a business. Just on this group, there's obviously this pretty wide range of types of businesses. We've got software, we've got, hardware, physical products. The cash needs and the business plans of your companies will obviously be very different. It's probably best maybe to start with some of the commonalities between your businesses with respect to fundraising. And one of the things I think is important when I think about both my own early stage businesses in the past, when I'm in the business planning phase, when I'm in the concept phase. Some of you are pre-MVP, some of you are kind of just at MVP, or maybe one of you is a little beyond that and putting your products into people's hands, and one of you are actually fundraising. The financial plan is, in my opinion, as much a part of the business and the process as any other aspect of the business, and it's frankly got to be considered really early on. And one of the reasons I say that is you're all putting time and energy, probably significant amounts of time and energy, to the extent you're committed to starting your own business, or you're very passionate about one of your concepts, or certainly I hope your own concepts. If you don't understand how the financial plan is going to work in unison with your product market fit plan, or even your go-to-market plan thereafter, you're probably going to hit a wall relatively early on. One thing I would say to all of you is to maybe change some of the mindset about that. I think I haven't seen many successful entrepreneurs who are not always fundraising. And it's very important to understand how the investor world, and we can talk about what some of the investor options are, but they tend to narrow. They tend to narrow at your stage of business, and we'll get to that in a sec. But if you've got some great plans and ideas of, all right, I'm going to take these steps with learning about my product, and I'm going to take these steps with learning about, the potential target market. You're going to hit a wall. So what can we do? What can we do at the beginning to, start to think about fundraising? Obviously, have to pick the amount, how much we want to raise, and who we're going to start talking to. I think just one of you has already gone down that road. I believe it was Sean. Is that correct? Sean, you're the only person that sort of started this fundraising process, right?
Yeah. Sorry, we're the only. This is my co-founder Arpit, by the way.
Hey.
Hey, how's it going? But yeah, we're on meeting number 4 now with investors.
Why don't we start there?
Sure.
So you've gone out. How'd you pick the number? And how did you decide who you were going to speak to? And what's that process been like so far? Just for the rest of the group, I think let's start with just a real live example that we happen to have on the call here, and maybe we'll dissect a little bit and talk about how some of it relate to the broader group.
Yeah, so I guess just kind of where our current stage is. So we had just finished private beta testing our app, and we've since kind of fixed those bugs, and we're gearing up for kind of the alpha version of our launch and our go-to market. So with that being said, we wanted to have a raise in order to really go to market effectively, and to be able to cover the costs that we would need with the investors we're talking to right now. We've been discussing with them at a safe round.
Does everybody know what a safe is? I see a lot of heads nodding, turning. So I think I'd best describe it as kind of a way of fundraising early on where you don't have to value your company. So, it's very hard sometimes to put valuations on early stage companies or initial products, or even sometimes concepts, but people like you, they like the idea, they want to back you. And it's, on some level, you're kind of pushing the valuation discussion further down the road when there's more metrics or more value markers to determine an appropriate value for the company. So we're all trying to, as early stage entrepreneurs, trying to maximize and maintain as much of our equity in our company as we possibly can. So the SAFE has become a very common form of really a legal document and structure around financing. I believe it's a simple agreement for future equity, where, instead of sort of a complicated convertible debenture where someone's saying, all right, I'll loan you the money and then we'll convert it at some discount to the round later. It's a really simple document and structure that's pretty much standard legal language and widely used in the early stage investment community to bring money in. It doesn't necessarily need to be a set amount of money. So Sean can raise on the safe terms today, which might say, hey, all right, I'm going to put in $100,000 into Sean's company. And then, when Sean does $1 million round, the safe is going to convert into the $1 million round valuation at a 25% discount or a 20% discount, or whatever Sean might negotiate with his current investors. So it's a simple way to get money into the company, and Sean can raise another $100,000 on the same terms. So you can sort of have a rolling financing instead of saying, all right, we're doing a round. I have to pick the exact amount of money I need for my company, which is probably very challenging for all of you right now. So Sean, what do your early investors look like? And are they friends and family? Are they people who have experience in your industry? How did you go about?
Yeah, so the one, it's 2 angel investors. So the one I met a couple months ago through a connection of one of our other advisors. And over the past couple of months, he had just mentored us on our idea. And about a month ago, I would say, he messaged me on LinkedIn asking if we were looking to raise. And I said we were, and he said, okay, I'm in. He said, let me see if I have someone else who might be interested in hearing your pitch. So we connected with and presented to him. So he's interested too. The final meetings are just to kind of finalize the terms of the safe.
Okay, I was gonna, so that's excellent. I want to touch on that with the group. And you know, it's great if you get people like that in early on who can write and want to write additional checks. And if you're dealing with certain angels, that's often the case. So that's a really positive thing to think about when you're bringing early stage investors into your company. If you bring somebody in early on, even if they're writing a $25,000 to $50,000 check, if they're not going to be able to write additional checks into your business, they're not always the most ideal person. Now, when you're starting out and you're scrambling to get cash any which way you can, perhaps you don't worry about it. If you do happen to find people who can write additional checks into your company, it always looks great to future investors when the existing investors are financing your business. The next person always wants to know what the people who know you best want to do. So it's definitely, you know, an aspect to think about your early investors, your early angel investors, or the people who are going on your cap table. Everybody knows what a cap table is? Cap table is just break down the shareholder list of your company. So I think that's great. So, you know, the other thing I'm hearing, which I think is also a phenomenal lesson with respect to fundraising and really important. Sean, you're always fundraising. You know, in the early stages of your concept development, it sounds like you're out meeting advisors. You know, you're talking to some accelerators, incubators, you know, potential angels who are in your space. Maybe they're in your space, maybe they're not. Maybe they just bring some general, you know, business building or you know, technology building experience to it. Maybe they've done a similar model in another business. But finding those people and getting those people around your business early on, even just to get their expertise, insights, and help for your business, that is part of the fundraising process. And so, you know, I think I think there's really two benefits to it early on. Number one, you've got to get other people around your business. You have to be talking about your concept very early on as you possibly can, and with people who, you know, you feel have some credibility for some reason, maybe along, well, you know, one of those factors I just mentioned with respect to how Sean might view his, you know, the value of his early investors. So doing that brings incredible amounts of insights and help and mentorship to your business. And it's amazing, you know, almost everybody you will go talk to will probably have the time for you. And, you know, there'll always be people who just won't, but they'll be few and far between. And, you know, if you're going to those people for, you know, certain reasons with respect to their experience and, you know, hopefully success, or maybe success and, you know, some of the potholes they've stepped in and, you know, slides they've had to endure over time. I've definitely experienced both. You know, they will also be people who can write checks into your business. So I think, you know, I think you are always fundraising, and you know, one of the really important aspects of fundraising, unless you're doing very, very close friends and family, as soon as you go out to these other groups, chances are they don't know you. And the most important aspect of fundraising, of successfully fundraising for every single person on this call, it's not your concept, it's not the size of your addressable market, it's, you know, it's not how smart you are, it's how well they know and trust you. And so that becomes, you know, that becomes the biggest problem and challenge for a first-time entrepreneur. How do I get people to know me and trust me? Because that tends to be why people will write a check at this stage of the game. You are all the most important aspects of your company at this stage. The idea's awesome. It's got to be good. You got to understand all the other aspects, and, you know, you're with varying degrees of certainty and probabilities at you know, at a very early stage. Investors all get that. But this is really all about you. How much grit and perseverance do each of you have? And how much integrity do each of you have? And integrity needs to be built up. So when you get the opportunity to show somebody early on, especially like an angel investor or a successful advisor who might be able to write a check later, and who can bring, most of them have networks and they like to invest alongside their peers. So if you get one, they'll bring a friend in, or like they'll divvy it up between a few people, and then you're expanding your network again. But the biggest thing there is to be able to get to know them and to deliver something. Deliver what you say you're going to do. And it doesn't really necessarily have to be a huge deliverable in your business. It could be something you've learned. It could be, meetings you said you were going to have and do. It is something to show them that you've got those traits that they want to back at this stage of business. So Sean, thanks for sharing. I think that, that highlights some really important and good lessons for the group, in terms of really starting that process. The other thing, at this stage that is worthwhile, is definitely understanding what the grant options are. So there's incredible programs out there with respect to, grant programs, everything from IRAP, where, the government is financing the hiring of employees, to just, straight out grant programs, depending on, which category that you might be in. So I think you want to be understanding what those are early, and you want to be planning for them early. So I think friends and family, your angel investors, and grant programs, I think are probably really the short list of early stage financing for first-time entrepreneurs. Right? It's, with your, if you had a track record, if you built a business and exited a business, if you had investors before, the financing strategy of your new business changes dramatically. You are up against other people who've started businesses before, and they fundraise on a business plan. And I'm just highlighting that now, not to, say you're at some big disadvantage. Every first-time entrepreneur starts the way you're all starting. But you can and should think about financing out of the gate.
So when raising, basically, via safe agreements, there is a preference for these guys to actually add in an MFN clause. We've got questions in terms of what does the MFN clause really entail? Why does it need to be there? What does it mean?
Okay, got it. So in the context of that, I would take it to refer to the fact that if I'm putting in money at a 20% discount to the next round, you're not going to have another safe in place after me that has a 25 or 30% discount to the next round. And if you do that, I'm going to get the same structure as the best terms you're giving out in market, prior to the next round. So, most favored, nation clauses sort of show up in financing documents, as well as sales and pricing documents, to large customers. But another phenomenal way to finance your business early on, and I think it, tends to be at some level of post product, is to have your suppliers finance your business, preferably through non-equity contracts. But sometimes a strategic, say, supplier or customer might want to put money into your business, and that's great. But I would always caution to make sure that it's not going to be too much of a presence on your cap table, and to understand what the potential implications might be for future investors into the business. So we've looked at investing in businesses in my VC life where, it's a little bit, it's not pure startup, but, we were looking at buying a portfolio company back from another company. So I won't, this is still a live deal, but so I won't mention the specific company. But the company we were buying back from wanted to maintain too sizable a share on the cap table, we believed that that would impact our ability for future financing. And maybe I'll use that as sort of a segue to another important thought around financing. And it might be most relevant to Sean right now, just because he's in the process of doing this round. But I think it's something for everybody to consider. There's two lenses that I have whenever I'm looking at whenever I'm looking at investing in a company. I've got sort of the bigger picture, like dream of what the company can become, right? Like how big is this thing? Is it worthwhile investing in this, in this new concept, in this new entrepreneur, in this new company? So all right, we check that box. The other thing that's really important is understanding where the money is going to get you. So when you do a SAFE early on, you've got a little more flexibility in that, because you're kind of already indicating to your investors that we're probably going to add more, we're probably going to raise more money on these terms. And it's not necessarily a deadline to the next round. But if you do a different kind of round, a different kind of investment round, or even perhaps if it's larger dollars being put into the company, or one person's writing a larger check, there's really got to be a view to where the money gets you. So that there's this timeline of money. There's the burn rate, and there's the runway of how long the money lasts that we kind of all talk about. But from an investor, what I really care about, and what I think you should all care about too, is where does the money get me in terms of value? So, what we always want to do is we always want that next round to be done at some higher valuation than the current round, than the current money that we're taking in. And there's some obvious things to that, some obvious aspects of and benefits of doing that. Number one, you're diluted less if you're raising your next round with more capital. But you also don't want to make sure you do down rounds. Down rounds quite often squeeze the entrepreneur, and they squeeze your early stage investors. So I think part of the capital plan and part of raising money is understanding what the value metrics are of your business. What's really going to build value? What do you think the investors really want to see once they put the money into your company? And it's not always the most obvious. It's not always just purely revenue or profit, because there's all kind of different multiples out there in market. And so what might the individual drivers be for your businesses to increase value? Is there anybody who's thought about that with respect to their business? And it's tricky, and there might not be a specific example, but regardless of the amount of money you're taking in, if you thought about your company in a year's time from now, what are some things you could accomplish that would deliver value for your business?
In terms of like a milestone that that kind of approach, our thinking with the investors we were talking to was to be in revenue in 2022. And that's based on the amount our pre-registered user base is currently worth. So although we're not charging our customers yet, they equate to that much in revenue. And then giving the multiplier in B2B SaaS, we assumed around a 10x. And so that was the milestone that we have really been keen on with our investors, and it's kind of the premise of that round that we're getting. And that's really the goal that they're going to hold us to for next year.
Yeah. And just, I'm going to ask you specifically, and your model is something I'm probably most familiar with, so I'll pick on you a bit. But why, I think this for the rest of the group. I just mentioned revenue might not be the only factor, but in your case, revenue is actually a huge factor. And so why is Why is your AI, why is your revenue structure really valuable?
Yeah. So in terms of our SaaS model, so that app, that's installed into their website, and it's a pretty pivotal aspect of their business, right? It's that last final checkout experience in shopping. So in terms of easily substituting that technology for another one, that revenue is pretty concrete, and it's necessary that they're going to need that. The revenue is fairly valuable for that.
It is. Agreed. And I think that's a great lesson. So you're going to have, if you're achieving those revenue milestones, you've got technology that is working and functioning. You're seeing how people use it. It is actually integrated into somebody else's workflow. It's integrated into essentially your customer's workflow and the commerce experience.
Yeah.
So you will have some kind of, we'll call them KPIs. You'll have other key performance indicators. You'll have other valuation drivers that go along with that revenue that will allow an investor like me to go, okay, you know what? I will understand, I'll probably understand a little bit about, it won't be a huge sample set. So, I might not fully understand your acquisition plan in terms of, exact dollars and metrics, but I will understand if you bring customers on, how I should expect them to behave. And then I'll take a look at that in the context of your market opportunity and say, well, you're showing it works. There's something value there. A value, you will have driven up value in your business by hitting that milestone. So it's a great example. Who wants to, if you're just way too early to think about this, that's okay. But who's got another example of what might deliver, value in their business in a year?
Yeah, I can go too. I don't have an exact metric as Sean does, because we're a bit earlier stage, but I know we can kind of quantify it as amount of retail stores that we've gotten shelf space on. That'd be a good, metric to kind of go after. Let's say once we start going and have a realize how many we can actually get into in a month or 2 month basis, then we could start, planning out, hey, we want to hit 200 retail shelves by the end of 2022 or something like that. So I think that for us is a good metric compared to Sean, where he's just basing it off revenue, just because it's different industry, different product.
Absolutely, great example. So when in your business, it's part of it. Distribution's part of the value.
Exactly.
Right, distribution's part of the value, and so got some experience in the CPG world. In your world, there'll be distribution. Different types of distribution will have different types of value.
For sure.
So your ability, so going through other channels and going through your own channels will have different value metrics to them. Right. So again, thinking of the capital plan, and think about financing early on. And again, none of this is thoroughly thought through, so take it all with a grain of salt. I just want to use the example to go back to the earlier point. If you're thinking about your capital plan very early on, you can map that to what your potential distribution plan might be, because your capital plan for going on other people's shelves and your capital plan for going direct to consumer are going to look really, really different.
Right.
So how do you, so how do you start thinking about that really early on? The financing plan needs to be thought of really, really early on. So I'd say, if those are your objectives for delivering some value, you've already started the financing process.
Right.
Let's pause briefly. Any topics that are of most interest? Any questions about what we've covered? Anything specific anybody would like to ask or discuss?
Yeah, I got a quick question. Let's say you're bringing a partner on to the team. How do you kind of value your business when you're so new to determine how much they need to buy into the company for? How do you kind of quantify that value?
Wow, that's a great question. So you probably will have difficulty. You will have difficulty valuing the business. Mm-hmm. So do you have just in your case, Albert, is there specific, is this kind of hypothetical that you're thinking about, or
No, because we're trying to bring a partner on now to help
out?
out in London. So we have an idea of like what we want, but we have no idea like whether that's appropriate to ask for or not. So just wondering if you've ever heard of any situations like how, like it's impossible, it's all an arbitrary number, but like, is there, a fair way to kind of create, like put a value figure on the business?
Got it. So, assuming this person's coming in and adding value to you,
right?
And complementing you, and you need those skills, and you want those skills in partnership as opposed to just hiring them. I think it starts with a negotiation, right? Like every single situation is a negotiation, each of your situations are going to be different, and someone might come in, they're your 50-50 partner because they bring so much value to the table, or someone's coming in and you're going to have to figure out a way to pay them something. So they're going to be drawing cash out of the business when you're drawing no cash out of the business. So they're going to have less equity than you. When you're at this stage, there's so many ways to slice it and dice it. What I think is important from an investor perspective when I see it is what happens when the shit hits the fan and something goes wrong in these early relationships, which quite often are cobbled together because of a need as opposed to a great fit, or an ideal fit. Early stage, whether they're co-founders, or whether they're people who are brought in shortly thereafter with a fair amount of equity. It's just some human relationships, right? Like things go wrong. And what is really important is that you don't have somebody with a huge chunk of your cap table and equity in the business that all of a sudden is no longer in the business. And I think perhaps the implications of that are obvious, but when you go a few financing rounds forward, and an investor, you need to raise real money into the company, whatever that number might be, 5, 10, 50 million, and the people running the company don't have enough of the equity, then you've got a sort of a cap table that's been turned upside down. It becomes very unattractive to future investors. And then we've got to cram down early investors, or we got to figure out huge option plans to dilute everybody in order to solve that problem. So it's a great question. It's important for everybody to think about as you have partners now, or think about bringing people into your business. So the best thing to do is have a conversation up front about it. And probably the simplest thing that comes to mind for me is essentially having some form of clawback feature or vesting feature on the individual's equity into the company. So on the vesting side, it's probably more like, most like an option plan, right? Like if it's not your co-founder, you could probably start bringing somebody else in. Depending where you're at, you may have to structure equity right away, depending on how integral this partner is going to be with you. If it is in fact a partner, if it's going to be sort of a co-founder of the business. So maybe it's if it can't be options, and you can vest options over time. So you vest options over 4 years. So if I stay 1 year, I get 25% of the equity that was given to me. If I stay all 4 years, then I get to keep all 100% of the equity. So that's sort of a common vesting schedule. A clawback option can be essentially that the individual buys into the business. And so if you don't, if it's too hard for you to value your business, the person buys in for $100, but then there's this clawback feature where you actually buy back the shares for $100 or portions of the shares over time, but for essentially the same number. So if the person's no longer with the company in a year, you buy 75% of the stock back for $75. So it's a great question. Everybody should think about it. The structure of it really affects your cap table and how attractive or not you might be in future to future finance partners. Does that make sense?
Yeah, no, that's a good answer.
Okay. Anybody else want to build on that or have questions about that or separate questions? Nothing pressing right now?
No, it's just it's a good point. Like, I'm also about to open up the search for a co-founder.
I think it's probably fair to say that when you get to the VC stage later on, there's no doubt that there's a preference for companies with co-founders. And perhaps 2 to 3. And it doesn't necessarily happen that they're all day one. But early stage founders, like we do have a preference for a team approach. Even when you raise money, the worst mistake is that all of a sudden you raise money and you haven't really had cash in the bank before, and you stop your efficient capital, lean startup, rapid development cycle, rapid learning cycle process that have brought your businesses to where they are today, and you spend too quickly.
Mm-hmm.
There's no better path to a down round than ramping up your business too quickly just because you've got the cash. If you don't, if you don't maintain that discipline of learning every time you spend cash in an early business, and building value markers with every dollar you spend, and you can't do it with every dollar you spend, but as efficiently as possible, then you will go to a down round, or you might not have the ability to do another round, depending what your cap table looks like after raising capital.
Mm-hmm.
We've talked about having the capital plan be done in unison with your business plan. Valuation, we've talked about safes and probably pushing that valuation down the road, which is quite often done by early stage entrepreneurs today. That's definitely where the market is. Negotiating with equity investors. Well, you don't negotiate with the equity investors if you're doing the safe. You're basically negotiating a discount to the future round. So, and a next round. So it's relatively similar. By the way, some don't even have discounts. But the only thing I'll say with respect to negotiation is it's supply and demand. If you have only one investor sitting at the table who's really interested in investing in your business, the investor will tell you what the valuation is. If you've got a number of people open to investing in your business, then you've got a little more flexibility to kind of play them off against one another, or look for the best price and try to convince somebody to take the lead on what you think your best price is. And once you have a lead investor, and a lead investor is basically the person who steps up to write it. If you were doing a round, let's say you were doing $1 million, you might get a lead in at least 250,000, where the lead comes in and they price the deal or they structure the deal. And then they said, all right, we're in, we'll put this money in, you raise the rest of the money, then you go around. When you're raising capital with a lead, it tends to be a lot easier than not having anybody on board. Investors are in investment rounds tend to be viral. They tend to have a real momentum aspect to it. And once you get going and once you start bringing others on, you gain more confidence. Other people see other people investing, and that tends to be how rounds come together and how they are how they're valued. And the last question on the list was, how can I best prepare and succeed in the post-investment phase? Which is a really good question. An existing investor is just like an existing customer. They are your biggest advocates. They are the people who want you to win. They are the people who will refer you to new customers. They're the people who will refer you to your next investor. And communication with them is hugely important. Hugely important. If you've taken the time and energy to get to know them over time and to prove yourself to them, there is no better time to do that than once they've put their money in. So, figure out a regular cadence of communication to your investors. Figure out sort of a template and a update structure to your business. By the way, there's tools like this could actually be good in the fundraising as well as the post-fundraising process. There's tools like Visible. It's called visible.vc. And Visible's just like, it's just a great, there's other products out there as well. Visible's a great tool for creating really nice, simple email updates. They've got templates on there from some of the accelerators. So you don't really have to think about, you sort of find a template that works well for your business. And then you just keep updating people. You update the people you meet and you update your investors, and you do it regularly. Maybe it's quarterly, maybe at some point it's monthly, maybe it's as news comes out that is relevant. Maybe it's when you met a milestone that you told them you were going to meet. But communicate is hugely important. Once you close that round, once you get your first money in on your safe, you are not done fundraising ever. You will always fundraise. So communication and regular communication, reports, use tools, make it simple, don't get bogged down in it. And if you value an investor and you want to make them feel part of it, pick up the phone and call them. And you'll get some that pick up you'll get a whole host of different kind of angels, different kinds of friends and family, different kinds of VCs. Some of them will want to talk. Some of them will be calling you all the time. Some of them will want to hear from you all the time. Some of them will put in money and never think about you again. That's how to succeed in a post-investment world with your investors. How you succeed in a post-investment world with respect to the success of your business is making sure you do things to build the value metrics of your business and stay focused. And I think there's about 1,000 layers to that, which we won't attempt to cover here today. But that pretty much rounds out all the questions on the fundraising list.
So does anybody else have any other questions?
Yeah, I have a quick question actually.
Sure,
I was just looking at your LinkedIn, Jonathan, and I was just wondering, I saw that you guys have kind of a focus on SMB SaaS. I was just curious about some of your past investments and like what stages they typically come in at and all that kind of stuff.
So I've done a whole bunch of different kind of like personal investing over, maybe over the last 10 years, but the three Celtic House deals, one was a seed round into a company called Door, which was a mortgage company, a mortgage technology company. So SMB SaaS focused, they sold the product directly to mortgage brokers, to manage their CRM and mortgage origination flow. And we like their sales strategy because they were going broker to broker in the early days. There were other companies out there, the existing companies in the industry, who were targeting the networks and the big enterprise sales. But what we really liked there was an early stage company that could have a real fast sales cycle. So they learned so quickly. We didn't care about their churn early on. They learned really quickly. And that's the benefit of sort of the SMB SaaS model.
Yeah, for sure.
So we like that. So that was the first deal. It happened to get taken out within 12 months by Finastra, sort of a larger financial technology firm. So that was kind of lucky that worked out on that timeline. But that was the investment thesis. So there's probably some good learnings there for you and your model.
Yeah, definitely.
Then I did a Series C investment into Aavik Networks, Ovic was an existing Celtic House Fund 4 portfolio company. So that's kind of why I was doing a Series C, just because it was captive. So
Okay.
I've invested with Celtic House outside of their funds because I'm recently joined, so I'm not a partner in their Fund 4. So I've done individual deals with them where I bring LPs to the table and we invest into a single company in a single vehicle.
Okay.
As opposed to, so my LPs are not in a fund; they go into one company. So Ovic again started out, and Ovic's really grown, and now they're focused into the IT world. They just had Great Hill Partners, private equity firm in the US, put about 300 million into their company. So we took we took half our capital out and rolled the other half of our value. So that was kind of lucky that worked out on that timeline as well. But again, similar start to the business where they targeted small, medium-sized SMB companies for their network management tools, like cloud-based network management tools. And so they were able to again grow really fast, or more importantly, learn really fast by having really short sales cycles and providing smaller companies what larger companies had, but couldn't afford enterprise products with.
That has been very well explanatory, and it's completely covered everything that we had on the table. With that, I'd like to thank you, Jonathan, for joining us today. It was fairly good coverage, and I'm hoping that everybody did derive good value out of it. With that, since we don't have any other questions in the group, we'll call it today. Thanks a lot, guys.